Good morning. My name is Ethan Wilk, and today I will be presenting a very bullish outlook on Lyft Incorporated, ticker LYFT. So ever since its IPO in March of last year, Lyft has been experiencing an age of adversity. It's worthwhile to investigate the causes for this downfall in order to determine whether it's justified. So what caused the fall? Well, first of all, Lyft had a very high IPO price of $72 a share, which gave the company a valuation of $20 billion. This high valuation led investors to meet it with a brutal year-long sell-off. Secondly, the company reported an unprofitability by $121.4 million in Q4 of 2019, which led many investors to believe that the company will never be able to become profitable again. Finally, the outbreak of COVID-19 has ravaged every corner of the market, but transportation has been hit particularly rough as Lyft has lost more than double the market from its peak this year alone. So what makes Lyft a bargain instead of a bust at these low prices? Well, first of all, the company's got some remarkable financials. Its debt to equity is a mere 16.69, which is more than 300% lower than its top competitor Uber's at 51.63. While acquiring minimal debt, the company's been able to realize a revenue increase of 52% year over year from 2018 to 2019. Additionally, as a result of the company's pricey IPO, they were able to raise over $2.9 billion in cash, which is much more than enough money to survive a recession and even to continue growing in the future. Now, analysts also predict some very promising figures for the company's future, including a revenue expectation of $12.1 billion by 2025 for a compound annual growth rate of 21.5%, and they expect EPS to grow to $7.24 a share by 2025, which is a massive uptick from its currently negative EPS. Additionally, the company's levered cash flow is a remarkable $307.6 million, which demonstrates the company's ability to responsibly manage funds, as well as indicates a very promising future for their financials. Now, alongside the company's financials, Lyft is one of the most unique business structures I've ever seen. For one, over 2/3 of the company's costs are variable, which means that they'll only be losing significant money if they're actually making significant money in the first place. Therefore, if no one's taking rides during the coronavirus, then the company will simply be losing less money. Additionally, to further cut on costs, Lyft's cars are the capital assets of the drivers, not the company. This allows them to avoid paying automobile taxes and things like that. And additionally, because the drivers are not federally considered employees, they don't need to pay things like medical plans or retirement. Finally, CFO Brian Roberts of Lyft has announced that the company plans to pull back on their $1.5 billion of research and development funding from 2019, as they're now able to finally realize the value of the non-current assets that they invested in 2019. Now, as a result of the fears developed from the outbreak of COVID-19, investors have been massively selling off Lyft's shares. They've lost more than 2 times as much as the market from its peak, and shares are now trading at a mere $22 per share, which is a fourth of their original IPO price. It's all driven by investor fear, but as a responsible investor, we must consider their core profitable business structure and their strong financials to determine that Lyft is actually a bargain at these low prices instead of a bust. Now, the ride-sharing industry as a whole also has some very high barriers to entry, as a Porter's 5 Forces analysis will show. First of all, the threat of new entrants is next to none due to brand recognition. Companies like Sidecar and Juno have already gone bankrupt in the past year due to an inability to compete with companies like Uber and Lyft. Additionally, in the case of a rising competitor, Lyft can always easily buy them out with their massive $2.9 billion cash cushion. Customer bargaining power for Lyft is also next to none because Lyft charges less on average than Uber does. And additionally, supplier bargaining power is similarly low because Lyft compensates its drivers $2 more per hour than Uber does, which lowers their turnover rate compared to Uber. And alongside doing this, they foster a culture of driver appreciation by introducing things such as the tip. Now, Uber is Lyft's main top competitor in the industry, but due to Lyft's superior management and their superior financial position, Lyft is expected to take over as the market leader within 5 years. Finally, the only direct substitute for ride-sharing is taxis, and ride-sharing is expected to take over the taxi industry within 5 years because ride-sharing is on average cheaper than taxis are, and they're more user accessible. So let's talk about Lyft's compensation model for its executives. At Lyft, executives are incentivized to make objective-based decisions because 99% of their compensation is given in the form of company equity. In doing so, the CEOs and CFOs are encouraged to make decisions in favor of profit and growth for the company down the line, because if they want to make more money, they need to increase the company's share price, which is a very promising model for investors. Market takeover is also imminent in this industry because, as a SWOT analysis shows down here, Lyft is in a stronger financial position, they have more flexibility, and this offers them more opportunities to expand than Uber. Uber, on the other hand, has expanded internationally too rapidly, and they're now focusing on damage control as they face the legal repercussions for rapid expansion. Now, speaking of market absorption, let's take a look at the demand for ride sharing, as it is the reason that investors have been ravaging the company's share price. As you can see down here, Lyft's users have increased 23% year over year from 2018 to 2019. Now, additionally, demographers have noted that over the past 5 years, migration to urban centers has been increasing rapidly, and this trend is expected to hold for the next decade. In doing so, demand for public transportation will increase, and ride sharing will fill this demand because it is cheaper on average than taxis are, and additionally, it's more user-friendly than taxis. Now, Lyft is not only innovating for the present, but they're innovating for their future. They partnered with Alphabet, Google's parent company, to produce the first driverless vehicles. So far, these vehicles have recorded stats that are safer, reporting a 90% reduction in accidents along the Las Vegas routes that use them. They're more coveted, as they've witnessed a 1,000% increase in orders for these driverless rides. And finally, they're more efficient, with an 80% reduction in traffic congestion along the routes that use these cars. Now, in creating these driverless vehicles, Lyft will be able to heavily cut back on costs because in a driverless vehicle, there is no driver, and as such, the company doesn't need to compensate anyone for doing the driving. Additionally, the company will be expanding their served available market because customers that never would have taken a ride before now can feel safer and more secure in these rides, which will offer rides to a much larger customer base than originally planned. This is a video from a journalist documenting her experience in one of these driverless cars.
One thing I'm noticing as we're stopping and starting here at the lights on the Las Vegas Strip is how smooth the car is. It just feels like Vernon here is a very careful driver. A car just kind of cut in front of us pretty quickly, and we did brake, but it felt smooth, and we didn't get too close to it. Honestly, sitting in the back seat, if I weren't paying attention at all, I would have absolutely no idea that we were in a self-driving car.
So as you can see from the video, the journalist felt that the ride was smoother, safer, and overall just better than an actual car. Again, this will work to improve the company's served available market because, as the journalist discussed, customers that never would have felt safe or secure in these cars will now be open to trying them. So this leads us into the company valuation section of this report. Where will Lyft shares be priced in 5 years? Well, we can use analyst expectations with a 2025 revenue estimate of $12.1 billion, an EPS estimate of $7.24 a share, and then an income estimate of $2.06 billion by 2025. Then we can use a standard PE ratio in the industry of 15 to determine that shares will be priced at $108.60 by 2025 for a 393.6% appreciation. Now, as with any investment, this one does come with some risks. First of all, California recently passed its AB5 law, which requires that companies like Uber and Lyft treat its drivers as federal employees. In doing so, they need to pay things like retirement plans and medical insurance. And as of now, this has been a negligible cost on the balance sheet, but if adapted on a national scale, it could become more costly. Lyft, however, does have contingency plans in place for such development. Secondly, acquisition is becoming increasingly possible as General Motors has been acquiring equity in Lyft, and now it holds 9% in the company. It could easily buy them out given GM's cash holdings and Lyft's market valuation. And while this would predictably spike the share price, it would also complicate the investment plan given in this presentation. Finally, there's always a possibility that this corona-induced recession extends beyond its expectations, which could cause Lyft to garner more debt acquisition or more cash expenditures than previously expected. So thank you for listening to my presentation, and I'll now be taking questions.